LLC versus S-Corp, the $20,000 decision every business owner must make. There's a single decision that could save you $20,000 or more every single year in taxes, and most business owners have no idea it even exists. Today, I'm going to break down the difference between an LLC and an S-Corp and show you exactly when you need to make the switch. If you're a business owner, you've probably heard the terms LLC and S-Corp thrown around. Maybe you have an LLC and you think you're all set. Maybe you've heard S-Corp is better, but you don't know why. Here's what you need to understand. An LLC and an S-Corp aren't the same thing. In choosing between them, or more accurately, choosing how your LLC is taxed, can be the difference between paying $30,000 in taxes and paying $10,000 in taxes on the same income. This isn't a minor difference. This is a decision that could save you 5 figures every single year. And if you've been in business for a few years and you've never explored this, you've potentially left 6 figures on the table. So let's break this down clearly so you can make the right decision for your situation. Understanding the basics. What are they? First, let's clarify what we're talking about, because there's a lot of confusion around this. LLC, Limited Liability Company. This is a legal structure for your business. It provides liability protection, meaning your personal assets are generally protected if your business gets sued or has deaths. By default, if you're a single-member LLC, the IRS treats you as a disregarded entity, which means for tax purposes, you're treated like a sole proprietor. If you're a multi-member LLC, you're taxed like a partnership. S-Corp. This isn't a legal structure, it's a tax election. You can elect to have your LLC taxed as an S-Corp by filing Form 2553 with the IRS. So here's the key. You can have an LLC that's taxed as an S-Corp. You get the legal protection of an LLC with the tax benefits of an S-Corp. The question isn't really LLC or S-Corp. The question is, should my LLC be taxed as an S-Corp? The big difference. Self-employment tax. So what's the actual difference when it comes to taxes? It all comes down to self-employment tax. As a sole proprietor or default LLC, you pay self-employment tax on all your profit. Self-employment tax is 15.3%, 12.4% for Social Security, and 2.9% for Medicare. This is in addition to your regular income tax. So if your business makes $150,000 in profit, you're paying about $23,000 in self-employment tax, plus your regular income tax on top of that. With an S-Corp, here's what changes. You become an employee of your own company. You pay yourself a reasonable salary, and you pay payroll taxes on that salary just like any employee would. But here's the key. The rest of your profit comes out as distributions, and distributions are not subject to self-employment tax. Let's do the math with real numbers. Scenario 1. LLC taxed as sole proprietor. Business profit $150,000. Self-employment tax $21,700. In theory, you pay self-employment on all the profit, but there's a few deductions, so it's actually this. You pay self-employment tax on the entire profit. Scenario 2, LLC taxed as S-Corp. Business profit $150,000, reasonable salary $90,000, distributions $60,000. Payroll taxes on salary $6,885, employee portion, self-employment tax on distributions $0. The savings? About $14,800 per year in self-employment tax alone. And this is on $150,000 in profit. If you're making $200,000, $300,000 or more in profit, the savings get even bigger. The catch? Reasonable compensation. Now, before you run out and elect S-Corp status, there's an important catch. The IRS requires you to pay yourself a reasonable compensation. You can't pay yourself a $30,000 salary when you're making $200,000 in profit and take the rest as distributions. The IRS will challenge that. Reasonable compensation means what someone with your skills in your industry, in your location, would typically be paid for doing the work you do.
Generally speaking, a good rule of thumb is to pay yourself about 60 to 70% of your profit as salary and take the rest as distributions, but this varies by industry and circumstances. The point is, you can't just game the system by paying yourself $1 and taking everything as distributions. But you also don't have to pay yourself 100% of your profit as salary, like you effectively do as a sole proprietor. When does S-Corp make sense? So when should you actually elect S-Corp status? Here's the general guideline. If your business is consistently making $60,000 to $80,000 or more in profit, it's time to seriously consider an S-Corp election. Why that threshold? Because there are additional costs and complexities with an S-Corp. You have to run payroll, which means payroll software or a payroll service, $500 to $2,000 per year. You have to file additional tax forms, Form 1120S instead of Schedule C. You might need more sophisticated accounting and bookkeeping. There are additional compliance requirements. So if you're only making $40,000 in profit, the savings might not outweigh the extra costs and complexity. But once you're consistently making $80,000 to $100,000 or more in profit and you're not an S-Corp, you're almost certainly leaving significant money on the table. Other considerations. Beyond the tax savings, there are a few other things to consider. State taxes. Some states don't recognize S-Corps or charge additional fees. You need to check your specific state rules. Fringe benefits. S-Corps have different rules for fringe benefits like health insurance. Generally, if you own more than 2% of the company, your health insurance premiums are added to your W-2 income, but you can still deduct them. Timing. S-Corp elections have specific deadlines. Generally, you need to file Form 2553 with the IRS by March 15th to have it effective for the current year, though there are some exceptions. Long-term planning. If you're planning to sell your business or bring in partners, entity structure matters. S-Corps have restrictions on ownership. You can't have more than 100 shareholders, and they must be U.S. citizens or residents. How to make the switch. If you decide an S-Corp makes sense for you, here's how to make the switch. Step 1. Form an LLC if you don't already have one, or you can incorporate as a corporation and elect S-Corp tax treatment. Step 2. File Form 2553 with the IRS to elect S-Corp tax treatment. Make sure you do this by the deadline. Step 3. Set up payroll. You'll need to start paying yourself a reasonable salary and withholding payroll taxes. Step 4. Update your accounting and bookkeeping to properly track salary versus distributions. Step 5. Make sure you're maintaining proper corporate formalities, keeping business and personal finances separate, maintaining records. It's highly recommended to work with a tax professional who specializes in this to make sure it's done correctly. If you're making $80,000 or more in business profit and you're not sure if S-Corp status makes sense for you, visit our website and book a free call with one of our tax strategists. We'll analyze your specific situation and show you exactly how much you could save. Thanks for watching, and I'll see you in the next one.